We're continuing on chapter 14, but we're going to start on slide 8, number 8, slide 45. So notice that we are now extinguishing debt. So they've been out there a while and we're calling it in. So it could be because the interest rate has changed and we don't want to pay such a high level of interest. So we issue new bonds and we take the proceeds to pay off old bonds. So on January 1st, General Bell issues at 95, so 95% of face. Bonds with a par value of $800,000 due in 20 years, so they're due in 2030. 8 years after the issuance date, they call the entire issue at 101, which means 101% of face. And that could be determined based on the interest rate, or it could be what you've agreed to with the bondholders if you call them. At the time, the unamortized discount balance is $24,000. So if I made a T account of the bonds payable is $800,000. And the discount, whatever it was in the beginning, I have 95, so 95% of that. So they issued at a discount, so I could tell whatever we've done, we have $24,000 left. Okay, so 95% of 800,000 is some number, and I've amortized it down. So if you had to compute all the amortization, you could do it under the straight line or effective, but I don't really have to because they give it to us. So notice that those two together, that minus that equals 776. They called them at 101, so I paid 800,000 times 101. The carrying value is 800,000 minus 24 because it's a discount. If that's a premium, I'd add it, but it's a discount. So I've got 776, 800,000 minus 24,000. So I paid 808 for something on my books for 776, so I had a loss. All right, so let's make that journal entry. Get the bonds off your books, 800,000 right here. Get the discount off your books, and you're going to have to go back and look. Thank heavens I still have that up there. Notice the discount was a debit because the carrying value was below that, so I get it off my books with a credit. I record the cash of 808 and plug the difference, so I have a $32,000 loss. Next one. Thing that we're going to talk about is we're going to talk about notes payable. Quite frankly, notes payable are exactly the same as bonds payable, except you call them notes payable instead of bonds payable. So there you go. So hopefully we'll get through this. The note is valued at the present value of its future cash flows. They amortize the premium or discount. So we have this one I didn't even copy because it's at face value. So the reason we never really have dealt with discount or premiums on notes is because when you walk into the bank and you borrow money, the banker tells you the interest rate that's in effect at that point in time. So the chances of a face and a market rate on a note are slim to none. So most of the time you have, again, I didn't even put it on the slide. If you borrowed $10,000, 3%, you debit cash, credit notes payable. When you pay the interest, you debit interest expense cash, principal times rate times time, since it's 1 year. There, you're done. Okay, that's how we usually do it. However, if you have a zero interest bearing note, just like the bonds, you can't have that. You have to impute the interest. So this one I do have. It's right over here, number 9. So we have a 3-year, $10,000 zero interest notes. So I like this that they drew it. So I'm getting $10,000 is going to be paid back at the end, and I'm paying zero interest for the next 3 periods. However, I know the interest is buried in that $10,000. So I have to bring this back to the present. If the interest rate had been stated at 1%, so I would have $100 here, then I'd have to bring back the present value of the note and the present value of the interest, but the interest is zero. So notice now I'm going to take it back to $10,000 times the present value of a lump sum for 3 years, 9%, because 9% is the market rate of interest. So $10,000 times present value lump sum, 3 years, 9%, gives me $721.80. So I credit notes payable always for the amount of face, Debit cash for the proceeds, and discount on notes payable is the plug figure, exactly like notes. Then, every year, I debit interest expense. You can go ahead and credit cash and put 0, because I paid 0 cash on this. And then I plug discount on notes payable for the difference. Okay, how's my interest expense figured? Carrying value, which is, back up a second, 10,000 minus 2278 gives you 7721. So 7721 times 9% is that. I assume annual compounding unless it tells me difference. And then notice my carrying value of the note goes toward face, so I'm going to add the discount, this one, just like I did in the bonds. This one, Marie Company over here, number 10. Issue for cash 10,000, 3-year note bearing interest rate of 10%. The market rate is 12%. So notice this is a 10% note, so now it has a face value. Okay, the present value of the note is calculated. So again, I'm going to figure out I've got a $10,000 note and it's stated at 10%. So 10% of that is $1,000. Remember that? Because that's what I'm actually paying. So I'm going to bring back, I have my little rate here, I'm going to bring back $10,000 present value of 3 years to force it to earn 12%. 3 years, 12%, and then I'm going to bring back the $1,000, boom, 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 present value of an annuity. For 3 years, 12%. You always use market in these computations. All right, but anyway, if I did that, you can go check it if you want to get your present value computations out and see if they did it right. You should get 9520. So I'm going to credit notes payable for face, debit cash for 9520, and I have a discount. And I'm going to have the interest, again, always debit interest expense, credit cash. So I'm going to debit interest expense, credit cash. Cash is always $1,000. Interest expense is carrying value, which is 9520 times 12%. So I'm going to do the same thing I did. This is always $1,000. Interest expense is carrying value times 12%, carrying value times 12%, carrying value times 12%. So my interest expense, carrying value times 12%. Cash is face value times face rate, which is $10,000 times 10%. Okay, and there's my interest entry. The next one would be, next period would be 1,000, 1159, and 159. Okay, what happens if I issue a note for property, goods, or services instead of cash? Well, I do it exactly the same way, except for my cash. My debit to cash and credit to notes payable is not a debit to cash, it's a debit to land. Okay, and so basically you assume the stated interest rate is fair unless there's a reason that would prove to be that it's not fair. Okay, how do you choose an interest rate? Well, if you had a 0 interest bearing rate from your parents and you wanted to see how much they've given you, call up the bank and see what you could borrow money for a car, for instance, and that's your prevailing. So prevailing rates on similar instruments, and then you might have some restrictive covenants, etc. So it's basically the fair rate. If you and I wanted to get a fair rate, we would all call up the bank and ask them what it is, and I bet we would get an interest rate that it's approximately equal. All right, this one, number 11. What these do we have left? 11, 12, 13, 14. We're almost done. On December 31st, Wunderlich issued a promissory note for architectural services. Notice it's for services. Okay. Really messed that up, didn't I? The note has a face value of $550, a due date of December 31st, and bears a stated interest rate of 2% payable at the end of each year. So this is the face. Make sure you circle that and write face. This is the face. So I'm going to circle those two things. This one and this one is the face. And so now I'm going to say $550,000 times 2%, and I can get that interest rate, and I'm going to write it up here. So 2% is what, 11? Okay, $11,000. So actually, I could care less about that 2% each more. On the basis of their credit rating, the prime rate of interest is 8%. So right there is the market. Then I double check about different compounding, and I don't have anything, so I'm going to assume annual compounding there. Okay. So the next thing I'm going to do, I'm going to show here. Okay, so I'm going to figure out the present value of the note. So I have my $11,000 interest payments, so I'm going to bring this back to the present. Present value of $550,000 times 5 years, 8%. So remember I said I had you circle that over here. The interest rate is 8%. And we've got $550,000 at 2% someplace in here, 2%. So I've got $11,000. Okay, so I'm going to force it to earn 8%. So the present value of a lump sum, 5 years, 8%. Then I take my $11,000 and bring them back for 5 years, 8%. Always use 8%, guys. Always use the market in these present value computations. So I get the present value of the 550 is 374, and the present value of the interest payments is 43. So I have 418. So this is my notes payable, and that's my cash. So we've done this over and over again. I can do this. So notice, credit notes payable, I said debit cash, but notice we were doing it for architectural services on a building, and every cost to get the building ready for its intended use is added to the cost of the building. So I debit building instead of cash, and the discount, and the rest of it's the same. So in the next period, I would have my interest expense, cash for $11,000. My discount, my interest expense is carrying value, which is 418. 239 times the market rate of 8%, so 33,459. My discount amortized is going down by 2249, and my carrying value is going toward face, so I'm going to add it. Next one, mortgage or notes payable. Most of the time, mortgage or notes payable, the only thing they're different is I make some principal payments and some interest payments as I go along. So I'm going to have my cash paid is going to be, actually, I might have another one, cash paid for principal. Okay, and so I'd have cash paid for principal out here, and then my face value of the note's going to keep going down, just like the carrying value is going to go down on that. So most common, pay full at maturity or installments, fixed rate, variable rate mortgages, they're not that big of a deal. Okay, fair value option. Fair value option is where you can ditch all this present value stuff and just record fair value. So notice this is a fair value option, not to be confused with the fair value methods. And so we're going to, you companies have the option to record fair value for most financial assets, notes payable, bonds payables, etc., etc. So in other words, instead of amortizing the discount or premium, I could compute the present value each and every year based on the market rate of interest. All right, so Edmunds Company has issued $500,000 of 6% bonds at face value, so no discount or premium. They choose the fair value option on December 31st. The bonds value now have 480. By the way, they did the present value, bringing back the face value and the market rate of interest. They just did that every year to get 480. And so now, under the fair value option, I don't have to have a discount or premium. I just debit bonds payable to get it from 500,000 to 480. So when I issued these, I debited cash, credited bonds payable. And now I need to get it down to 480, so I debit it and credit unrealized holding gains or loss. Okay, last couple things. You can read through those. Those are important and interesting. Present and analyze long-term debt. Off-balance sheet financing. Off-balance sheet financing would be kind of a way to keep debt off your books. So for instance, let's pretend you as a family Your parents need some money, but they can't borrow any money because they have too much debt and the bank won't accept a loan from them. So they get you to borrow the money and they pay you back. That would be a non-consolidated subsidiary. Most of the time that you're required by GAAP to consolidate significant subsidiaries. So these are generally thought of as a little bit fraudulent. Okay, now sometimes you can do this, like for instance, when I went and visited Shell Oil Company, the parent, actually always borrowed the money because they could get a lower interest rate than the subsidiary. So sometimes if you have a subsidiary who can borrow money at a lower interest rate, you have them do this, but then you disclose it all on your notes to your financial statements so everybody sees it, or you consolidate them and include them in your financial statements. Special purpose entities are kind of the same way, that you have the sub borrow the money, and again, most times when you leave it off, it's fraud, so there are rules on that. And operating leases are when you lease something instead of buy something to keep the debt off your books, and current FASB requirements require that you capitalize almost all leases. So that's kind of, most of that's gone away that you can do off balance sheet financing. Okay. This is kind of interesting. Please read Enron's abuse there as far as that goes. Presentation of long-term debt. You have to disclose, look at everything you have to disclose. Maturity dates, interest rate, call provisions, conversion provisions. In fact, you give a big description of your bond. You can have to do future payments for sinking fund requirements. What a sinking fund is let's say you have a $100,000 bond due in 10 years. It's a term bond. It's not due to the end. But the bondholders require you put $10,000 a year away in an investment account that you can't use for anything else but to pay back that bond. So you can use the income off that $10,000 any way you want, but you better put $10,000 a year in it. So at the end of 10 years, you'll have enough cash in that sinking fund to pay back the bond. Okay? Next one. Analysis of long-term debt. You have liabilities to assets. Okay, that's debt to asset ratio. How much of, do you have comparative wise? Obviously, if this is as much liabilities as assets, you have pretty close to bankruptcy there, because every one of your assets is borrowed. So kind of a new business might have this, where if you borrow money to start a business, right there, you're going to have your liabilities equal your assets. So a more mature company, you would expect that to be like half. So half as much liabilities as assets, or so 0.5 or something like that. Times interest earned ratio. Times interest earned is basically income before income taxes and interest expense divided by interest expense. So basically what this tells you is how many times over can you pay your interest expense. So let's say I have $100 of net income and I have interest expense of $10, so my net income is $90. I'm also not even going to put income taxes in it. So basically what I'll do is I take 100 income before income taxes and interest, because this is my net income, that's my interest, this is my every other income item, interest expense, so net income. So I take this line, and I take that divided by 10, and I can pay my interest expense 10 times over. So I'm a pretty good risk as far as lending additional money to, because I can pay my interest times 10 times over. Obviously, if I'm at a loss and I still have interest expense, I'm hurting because I can't even pay my interest expense once. Okay, so this one is your last one. Target has liabilities of 27,407, total assets of 401, interest expense, etc., etc. So take a second to read that. So my debt to assets, I'm going to have to make this large. Bear with me so I can show this. Okay, so my debt, total liabilities 27, my total assets 41. So my debt is 66% of my assets. So if I compare that to a company with only 50% of its assets financed with debt, I have more debt. I'm weaker. I'm more risky. Okay, whereas times interest earned, my net income is 2449. So notice that I would have some number, subtract interest, subtract income taxes, and end up with 2449. So I'm going to back up to income before taxes and interest. So I'm going to add back my interest expense of 882 and add back my income taxes so I can get the number before I subtracted those out. And I divide by my interest expense, and I can pay my interest expense 5.4 times. Okay, so compare that with another company. If another company has debt of 50% and they can pay their interest 10 times over, they're a safer company. They're less risky. So it's really, you can only compare it to prior years and other companies. So there you go. We are on the appendix and we are finally done. That was kind of long.